I want to take a minute and wish everyone a very happy holiday from me to you. Today is going to be a short video. I really just want to highlight some of the impacts that the Fed's decisions makes, or the Fed decisions has made on investors like you. So to start at the top left, mortgage rates have dropped 0.75% from their October peak, consistent with the declines in Treasury yields. As inflation pressures ease, so will bond yields and mortgage rates. The Fed is probably done raising rates. The market now turns its attention to when the Fed might start reducing rates. No change is expected at the January meeting. The Fed documents from this past meeting show its policy decision makers expect to cut interest rates by about 75 basis points, 0.75%, 75 basis points next year, projected to be in three different intervals, so a quarter, a quarter, and a quarter. The annual inflation was at about 8% when the Fed started raising rates last year. In June, it peaked at 9.1%. And then as of November, inflation was down to a more manageable level of 3.1%. Now, with the 10-year Treasury yield off its 52-week highs and investors expecting a lower Fed fund rate in the near term, investors have become much more enthusiastic about the stocks in the last couple of months, if you've noticed that in your stock account. Credit card rates are closely tied to the Fed fund rate, so at least for now, these will remain steady with the hope of decreasing next year. Remember, credit card balances are at an all-time historic high. So those are the impacts that the Fed's decision last week has made on things that impact your life, right? Rates definitely have come down quite a bit in the last 6 weeks. They've come down 0.75%, like I said before. Rates last week for a weekly conventional mortgage rate, owner occupant, it went from 7.07 to 6.83, so continuing to come down a little bit. Keep in mind, these rates are building in projected easing. So the market is building in what it thinks is going to happen in the near future. Those were owner occupant rates. So investor rates tend to be 1 to 1.5% higher. So that would bring us anywhere from 7 to 10% on a 30-year fixed rate investor DSCR. Remember, those are all based on credit LTV and DSCR calculations. My recent quotes I've been running have been in the 7s and the 8s. It depends on credit, LTV, and DSCR calculation. As you guys are out there buying, flipping, building houses, you just let me know if there's anything that I can do from a financing standpoint to help you. Thank you and have a great holiday.